putting a rule forward where there has not been any kind of analysis, no cost-benefit analysis, when all we're hearing from communities, from securities communities to farming and ranching and rural communities like mine, South Texans will be affected if this rule goes into place. And the repercussion of it could be crippling local economies like mine that are rural and that are largely Hispanic.
It's a trade-off. You can have perfectly safe banks, but no lending to and other banking services, or you can have unsafe banks and a lot of lending and other banking services. What we're trying to do is we're trying to hit the right balance. And the question is, we've been increasing capital now for a number of years. Are we at that right balance, or do we need to have still more capital? It's not cost-free, despite what some people say.
I think it'll be a detrimental impact on small businesses because of the retail exposure provision in this proposal. On top of that, you have the operational risk provision in the proposal. And I think that, especially talking about community banks, I think community banks are actually affected in this because of the credit card interplay here, because a lot of them have to use larger issuers to issue their cards. And I'd just like to note that 82% of U.S. households have at least one credit card. So it is a large swath of Americans that will be affected.
Meaningfully putting us on a trajectory to leave a better planet than the one we inherited from our parents for our kids, and then cut it off at the knees, because even though this is a small piece of the Basel III rules, it's a big deal for the clean energy industry that is basically making decisions to invest right now based on whether or not they can monetize the tax credits that we passed last term. So I hope we can fix that.
Just to be clear, I would like to state for the record that SVB's failure was about liquidity, not capital. And I think it also had to do with the mismanagement of the banks and the failure of the regulators.
I think the genesis of this is that in 2017, agency staff agreed to Basel, and now they're getting around belatedly to implementing it. And there are good arguments for having international standards and some similarities among capital requirements. But what I find what's so perplexing and concerning about this proposal is that's not really what they've done. They've added in almost every case to the Basel risk weights they agreed to. The securities listing requirement that Randy talked about that disqualifies small businesses from access even to a 65% risk weight when the numbers show it should be 30 to 40. Well, that was jettisoned by both the European Union and the UK. And of course, here we have the stress test that they don't have. So I understand the spirit, let's get Basel done, but this isn't Basel.
My message to the boards at the Fed and the FDIC is that merely recalibrating treatments of mortgages and green energy tax credits in the proposal and reducing the punitive and unjustified operational risk penalties in the proposal will not resolve our concerns or fix the remaining significant problem areas in the proposal. There are far too many other fatal flaws that need to be addressed, including treatments of market risk, exposures to companies with public listings versus non-public listing, abandonment of internal models, effective repeal by regulation of the tailoring law, and the interplay with stress tests. The federal banking regulators should scrap their faulty Basel III Endgame proposal and reevaluate what, if anything, may need to be done. At most, the regulators need to start over, undertake proper analysis, follow proper administrative procedures, and repropose a significantly different rule.